Have you ever heard the saying, dividend investing is for retirees only? Well, prepare for a reality check. Welcome to the world of dividend investing, where myths and misconceptions can often cloud the truth. One such prevalent myth is the notion that dividend investing is a domain reserved strictly for retirees. This perception likely stems from the fact that retirees, seeking a steady stream of income post-retirement, tend to gravitate towards dividend investing. However, this is a narrow view of a broad investment strategy. Dividend investing is not just about generating a regular income, it's also about capital appreciation, a concept that is often overlooked when dividends are mentioned. When a company is profitable enough to distribute dividends, it's a sign of financial health, which can lead to an increase in the company's stock price over time. This dual benefit of income and potential capital growth makes dividend investing appealing to a wide range of investors, not just those in their golden years. Moreover, the power of compounding, one of the key principles of investing, is particularly potent in the realm of dividend investing. Even for those in the early stages of their investing journey, reinvesting dividends can significantly enhance their future wealth. This is a clear example of why dividend investing is not just for those who've stopped working, but also for those who are actively building their financial future. The importance of debunking myths like these cannot be overstated. Misconceptions can lead to missed opportunities and misguided decisions. As we journey through the world of dividend investing, we'll bust some more myths, empowering you with the knowledge you need to make informed investment decisions. So, let's dive right in and start debunking some dividend investing myths. Myth number 1, dividend investing is only for older, retired individuals. Let's debunk this misconception right away. It's a common belief that dividend investing is a strategy best suited for those in their golden years, looking for a steady income stream. However, this is far from the truth. In reality, dividend investing is not age-specific. It's a strategy beneficial to investors of all ages, from fresh graduates starting their financial journey to seasoned professionals planning for retirement. Dividend investing is a powerful tool for wealth creation over time, thanks to the magic of compounding. Let's illustrate this with an example. Suppose we have two investors, Alex, a 25-year-old starting to invest, and Morgan, a 50-year-old with a more established portfolio. Both decide to invest a portion of their income in dividend-paying stocks. Alex, being younger, has the advantage of time. Even with smaller investments, the dividends earned are reinvested, buying more shares, which in turn generate more dividends. This cycle, known as dividend reinvestment, allows Alex's wealth to grow exponentially over time, illustrating the power of compounding. By the time Alex reaches Morgan's current age, the portfolio has grown significantly due to the reinvested dividends. On the other hand, Morgan, while starting later, can still benefit from dividend investing. The dividends can serve as an additional income stream, supplementing other earnings or pensions. Moreover, Morgan can also choose to reinvest the dividends, further boosting the portfolio's growth. So you see, dividend investing serves different purposes for different people. For the young investor, it's a strategy for long-term wealth accumulation. For the older investor, it provides a steady income stream and the opportunity for further growth. Therefore, the notion that dividend investing is only for older individuals is a myth. The truth is, regardless of age, anyone can leverage dividend investing to their advantage. It's all about understanding your financial goals and how dividend investing can help you achieve them. So, no matter your age, dividend investing can play a pivotal role in your wealth-building strategy. Myth number 2, dividend-paying companies are slow growth. Let's clear the air on this one. The perception that dividend-paying companies are typically slow growth is a common misconception. In truth, many successful, high-growth companies do pay dividends, and they do so for a variety of reasons. For instance, dividends can be a sign of financial health. Companies that consistently pay dividends are often those that have stable earnings and strong cash flows. They're successful, they're profitable, and they're sharing that success with their shareholders. Let's delve into the data. A study by Ned Davis Research showed that between 1972 and 2019, dividend-paying stocks in the S&P 500 outperformed non-dividend-paying stocks by a significant margin. The study found that dividend-paying stocks returned an average of 9.3% annually, compared to just 2.8% for non-dividend-paying stocks. That's not indicative of slow growth, is it? Further, a report by MSCI found that companies that initiated or consistently raised their dividends had higher earnings growth. The report analyzed data from 1997 to 2017 and found these companies had an average earnings growth of 10.9%, compared to just 8.2% for non-dividend payers. What does this mean? It illustrates that dividend payments and company growth are not mutually exclusive. On the contrary, they often go hand in hand. Companies that are confident in their future growth prospects are more likely to share their profits with shareholders in the form of dividends. In fact, a company's decision to pay dividends can actually be a sign of its confidence in its future growth. By paying a dividend, a company is essentially saying, "We're doing well, and we expect to keep doing well. Here's a share of our profits to prove it." So let's bust this myth wide open. Dividend-paying companies are not inherently slow growth. They can be, and often are, successful high-growth companies that are confident in their future and want to share their success with their shareholders. Therefore, it's clear that dividend-paying companies are not necessarily slow growth. Myth number 3, dividend investing yields lower returns. It's a common misconception that dividend investing is the slow tortoise in the race, trailing behind the hare of other investment strategies. This myth, however, is largely unfounded, especially when we take a look at the long-term picture. Let's delve into the numbers. Data has consistently shown that over time, companies that pay dividends have outperformed those that do not. In fact, a study conducted over 25 years found that dividend-paying stocks in the S&P 500 index yielded an average annual return of nearly 10%, compared to just over 6% for non-dividend-paying stocks. But there's more to the story. This isn't just about the dividends you receive, it's also about what you do with them. Let's talk about the power of reinvested dividends. When you reinvest your dividends, you essentially buy more shares of the company. More shares mean more dividends, and more dividends mean even more shares. This is the magic of compounding, a snowball effect that can significantly amplify your wealth over time. Consider this. If you had invested $1,000 in the S&P 500 index and reinvested all dividends, your investment would have grown to over $17,000 in 30 years. However, if you had chosen not to reinvest those dividends, your investment would only be worth approximately $10,000? Clearly, the power of reinvested dividends can play a crucial role in enhancing the returns from dividend investing. It's an approach that requires patience, but the rewards can be substantial. So the next time you hear someone say that dividend investing yields lower returns, remember these numbers. Remember the long-term perspective. Remember the power of reinvested dividends. Dividend investing isn't about chasing the quick win. It's about steady, consistent growth. It's about building wealth over time, brick by brick. As you can see, the potential returns from dividend investing are far from low. Now that we've debunked these myths, what does this mean for you as an investor? In this enlightening journey, we've peeled back the layers of misconceptions, revealing the truth about dividend investing. Let's take a moment to reflect on the key points we've discussed. We started by demystifying the age myth, establishing that dividend investing is not just for the elderly or those nearing retirement. It's a viable strategy for anyone, at any age, who is interested in creating a steady stream of income. Next, we tackled the slow growth myth. We discovered that companies that pay dividends can also be growth-oriented. These firms are often financially stable, with a history of profitability, making them less susceptible to market volatility. Then, we addressed the low returns myth. We found that over the long term, dividend-paying stocks have historically outperformed non-dividend-paying stocks. Dividends can provide a cushion during market downturns and contribute significantly to total returns over time. Throughout this journey, the overarching theme has been the importance of making informed investment decisions. As we've proven, dividend investing is not a one-size-fits-all strategy. It requires careful consideration of your financial goals, risk tolerance, and investment horizon. So, where do you go from here? The beauty of investing is that it's a continuous learning process. There's always something new to discover, a different perspective to consider, a fresh strategy to explore. The knowledge you've gained today about dividend investing is a powerful tool. Use it wisely. Incorporate this understanding into your investment strategies. Do your due diligence. Research the companies you're interested in. Understand their dividend history and payout ratios. Look at their growth prospects. And most importantly, stay patient. Investing is a marathon, not a sprint. Remember, knowledge is power. The more you know, the better decisions you can make. Happy investing.